Hello everyone, today we will discuss IAS 2 inventories, which is an accounting standard that deals with how inventories should be recognized, measured, and presented in the financial statements. Inventories are a major part of companies' assets, so understanding how to value them correctly is very important. Moving to the introduction part, that IS2 provide guidance on accounting for inventories. It tells us what inventories are, how to value them, how to present them and in the balance sheet. And the main goal is to ensure that inventories are stated at the lower of cost and NRV, which is net realizable value, which I will talk in the upcoming slides. And this is important because it ensures that the assets and profits shown in financial statements are realistic and not be overstated. Here's what we will cover today. That is scope of IS2, definition of inventories, its recognition, its measurement, and we'll talk about what is NRV, its presentation and disclosure, and I will talk about some example and some common mistakes which most of the students do and some key takeaways. Moving to the scope of IS2, IS2 applies to most inventories like raw material, work in progress, finished goods, and goods held for resale. And it doesn't apply to construction contracts, financial instruments, or biological assets related to agriculture. This is important because these items are covered by other standards. Moving to the definition of inventories. Inventories are basically assets that a company holds for sale or that are in the process of production for sale, or materials to be used in producing goods or services. Essentially, anything a company has that it plans to sell or use in the financial business falls under inventories. Moving to the next slide. That is the recognition of inventories. Inventories are first recognized an asset when it's probable that future economic benefit will flow to the company and when the cost can be measured reliably. Later, inventories are recognized an expense either when they are sold, basically this is the cost of sales, when their value falls below the cost, that is NRV. And here is the measurement of inventories. Basically, the inventories are measured at the lower of cost and NRV. In this, cost includes purchase price, transport duties, direct labor, production, and overheads. And in NRV is the estimation selling price minus the cost to complete and sell goods. I will explain NRV in upcoming slide. In the cost of inventories is made up of three parts: cost of purchase, cost of conversion, and other costs. The cost of purchase include price paid, transport, and import duties, and the cost of conversion include labor and production overheads, and the other costs include only those necessary to bring to its current state. And yeah, and some cost formulas allowed in this standard are uh, first in first out and weighted average cost. Here is the net realizable value. Basically, NRV is the amount you expect to receive if you sell the inventory, right? After subtracting any cost to finish and sell it. Basically, the formula is we have NRV is equals to estimated selling price minus cost to complete minus selling expense. I will explain example in the upcoming slide so you can understand it better. Here's the example that let's take let's suppose an inventory cost is 100 AED, 100,000 AED, and its expected selling price is 95,000, and the selling price is 5,000 AED, right? Now we have to calculate NRV, that is 95,000, that is expected selling price, minus 5,000, that is selling expense. So we get NRV is equals to 90,000 AED. Now we have to see that which one is lower. Does the cost is lower or NRV is lower? So hence we can see that the NRV is 90,000 and the cost is 100,000. So the lower is NRV. So the inventory will be valued at 90,000 AED, and the remaining 10,000, which is cost minus NRV, 10,000, write down of 10,000 will be charged to profit and loss statement. Here's the presentation and disclosure of inventories. The presentation is in the balance sheet. Inventories are shown under current assets. They are always presented at the lower of cost or NRV. And the disclosure requirements are that the accounting policies adopted for inventory measurement, cost formulas used, that is FIFO or weighted average, and the total value of inventories and the amount of inventory expense during the year. Here are some common mistakes by students that students mostly ignore NRV and value net cost only, using LIFO, which is not allowed under IAS 2, and including abnormal cost or storage cost in the inventory cost. Let's summarize the key points. That inventories are measured at lower of cost and NRV. Only FIFO and weighted average methods are allowed. Proper inventory valuation directly impacts profit and financial position. I hope this video helps you to understand the inventories. Thanks for watching.